Hello investor, how are you? Hopefully you're having a very good time. In today's video, I will going to analyze the Google stock analysis or do the full valuation. Myself, Pramod Kumar, I am a CFA charter holder and FRM certified. If I see from the agenda perspective, we have a very long agenda as you can see on the screen. The price returns, we'll see, and then we'll see the modes, if any, on the Google still left, the margins, liquidity check, risk, stock repurchases, intrinsic value. I'll calculate whether it's a good time to buy. It will help with the help of these three models, and also with the help of three models, I'll see what will be the stocks after 10 years, and given the today price, if we invest, what will the rate of return will get out of that. So it's a pretty very big agenda. So without any further delay, let's get started. So as you can see on the screen, so I have the price return. So if you have invested in 2010 and then in 2019 year end, we can easily see the price, the return of 16.10, the year over year returns from the Google. But if I see just from the past 5 years, the return is less. It's not very, it's still over 10%, it's 11.13%, but it's still a good. Google is not paying any dividend, and I haven't seen any in news or anything that they are planning to do so that's why we only rely on the price returns, but they do have the share repurchases in the past. Okay, so let's go next. So if I see from the modes perspective, what driving the Google, so basically I can easily see that the main business is for sure their search business, which we are familiar with, right? But search is, I'll focus more on the search on the risk section as well. But what other sections when Google has now is more like an alphabet, right? So Google is a G component out of that alphabet. I can see from their 10K that cloud business is increasing as well. So year over year is increasing. They have bet into many of other ventures and capitals, but few of them, which I think it's quite good, I highlighted here. The one main thing, which is the Google Nest. Google Nest is a very good product. I even personally use Google Nest, and I see many. If you go Home Depot and all, you can see that thermostat or the Nest cameras is very good and very good qualities. So that's very good in terms of diversification from the hardware perspective. Similarly, they have their Pixel phones, right, and the devices, Chromebooks and all. And the Pixel phone I haven't used, but they're coming into the phone market as well. So they're tapping into the electronic. They did quite a good interruption in the market with the Android, right? Before, if you think, we only have Apple and then BlackBerry, and when the Android jumps into the markets, it's a game changer. Right now, there's a lot of Android. The other 2 points which I like to highlight here, I think it's not, they're not making any money out of it, but they're doing research, is there Waymo, which is the autonomous cars. This is a big kind of a segment here. So for sure, the models predict only the past, and so this is, I think, is a very big if in the near future. So you can see the company, the informations on this.com. And another thing is, I also like another very big sector is a fight age-related diseases like the calico. That's also the health sectors. So in this one, I think this will also can be a very big, but for sure they're working quite in the past in the autonomous car sector. So if it comes, it will be a game changer for Google for sure. So these are the two big driving. These are the big driving, and then maybe other factor as well. But then I have picked these ones for the modes. So let's go to the financials next to see how the company is doing. So if you see from the margin perspective, this is a very rich data. Let me put myself on the hide so you can easily see that. Okay, so from the margin perspective, the blue one is the gross margin. As you can see, the 10 years ago, 2010, it was 64%, and now is declined to 50 5.8%, right? Almost 10% reduced. And but if I see from their operating margin and the net profit margin, it's looks quite good, right? It's been fluctuating honestly, so it was very good in terms of 10 years ago. We cannot just compare because it was 35% operating margin, as compared to now it's only 21%, right? 15% almost dropped there. And same thing, but their net operating margin is also almost 8-9% drop as compared to the past 10 years. In between, in 2017, it was a big dip in terms of net profit margin, but then they come back. So overall, I think if I can take away from this slide is the margin is reducing, but don't have to worry, because still the margin is, the bottom line is above 20 and the top line is above 50%, so which is very good. On the liquidity checks, size is clearly shows anything above 1 is good, but both the cash ratio, which is on the orange line, it didn't come very well, and the current ratio, which is a blue line, which is way above, right? So mostly in the technology company, they are quite good in terms of the liquidity. And so these are not only 100% up, this is more like a 400% up in terms of short-term liquidity perspective. I didn't see any problem with the Google for sure. So now let's say talk about the risk. So the risk is, as we can see, I can see the two kind of a risk here. So the first is, for sure, I have mentioned that most of the revenue is coming from their ad, right, which is 83% of the revenue. Although they have uh, diversified in other section, which I have classified in modes, but it still is very small in terms of the revenue percentage. And the second thing is the revenue growth declines, which I have already shown in the margin sections. Other than that, wherever they compete, for example, they have a YouTube, we have a Netflix and other, the very strong competition. But nevertheless, their core backbone is the search. And going forward, we also see like a Bing is there from the right, and other search engines are there. But I don't think so anywhere is near to the Google, at least from most. That's mostly people are still using it, and their mobile platform search, so with their Android and other, right, so they are still into the search, and I don't think so it will be that any in near future I can see any other company will take over from the search perspective. So I don't see this from the risk, much from the risk, but I still highlight that. Okay, this is very good from the stock repurchases. So the company has is on July 27, 2020, the company announces to share repurchase of $28 billion of the shares. It doesn't have any expiry date, so don't think that it will go. They will go immediately and market and buy back. But still, the board has allocated, authorized that much funds. So if nothing happened, at least this is another way of company to give to back to shareholders. So this is a very very big plus sign for Google. Now let's look into the intrinsic value. So for that, I'll summarize it, but I will show you my spreadsheets and go over that. So let me pull the spreadsheet out. So now what I have done is will show you the three models. The first one is the net profit model. Then I'll go to the enterprise value model and free cash flow models. In all three models, I have used the past 10 years of data and then projected for next 10 years, right? So let's go one by one and you will see that. So as you can see there, this is the net profit model for sure. Then I have if I see the year over year, the revenue growth is for the last 10 years is almost 19%. And for the revenue growth for the last 5 years, if I see, it's almost 17%, right? Similarly, but the good thing is, although the revenue growth is declined, but the net profit, the bottom line growth over the last 5 years is increased, right? From almost 15 to 17%, which is a good sign. But for me, I have taken the average 5-year net profit and then projected the net profit or the earning for the next 10 years, right? The initial growth rate which I have started is I have taken the conservative, the 15 years, but then I have declined the growth rate and bring to 7.5%, and I have declined a small spread out of it, right? So I'll see, because the revenue is going down, and I assume the growth aspect of the net profit, I'm taking it conservative and growing down as well. So I have grown that one, and then take the last 10 year of PE to take the terminal value of the 10-year growth. I have taken the required return of 10%. So if the stock value comes below 10 or at pars, I don't want to invest in that, right? It will help me to get into the fair value of the stocks. Okay, so this is the idea, and then I'll follow the same approach. If I do that one and get the market cap in million, divide by number of share outstanding, the the intrinsic value I'll get it $1,635 for with my first model, right? If I'll do the stock prediction for the next for the next uh, for the 2030, right? Then with this one, because of my projected growth, I'll say I can easily see the stock after 10 years is will be 32 see if I invested this much, and then my return is year over year is for the next 10 years is 21.81% with this model, the very first model, right? So let's take the second model, which is the enterprise value model. In that one, what we have to do, I have taken the again I have to compute the enterprise value of the company, right? So for the next 10 years, so these are the number of share outstanding times the market times the price, and then I get the market cap, right, which is nothing but this time this, and then I reduce the debt and add the debt and reduce the cash. I'll got the enterprise value. So that's what I have done for the next for the all 10 years. And if I see this ratio, which is a very good ratio, the enterprise value or EBITDA, this ratio has been quite consistent. It was 13.43 to 17 right now. So this ratio is quite increasing. The reason, right? So this means if you go and buy the company, it will take you at least 7 years, 17 years, 0.54 years to get your money back, right? But the good thing is the debt for this, since the very first year I don't have debt, so that's why I'm highlighting here. The debt CAGR is only have taken for the 9 years, right? But the enterprise value is again increased by 18% over 10 years. If I take the past 10 years, by at the rate of it almost 18%. But for the last 15 years, it's increased at the rate of 11%. So this margin decreased. Okay, again with the second model, I have computed taken the EBITDA growth rate for the next 10 years, and then the terminal value. I have taken the last average of this EBITDA, which is coming as 15, right? Discounted by again by the 10%. So with the second value, my intrinsic value is coming as $1,500, $1,557.82. And then my prediction for the next 10 years, the stock price is $2,500. If I invest right now with this money, go into the market for the next 10 years, I can easily make, its second model is giving almost 17% return year over year, which is not bad, right? Okay, so let's go to the final, the third model. And then for the third model is a free cash flow. I have to project the cash flow. So I have taken the operating cash, reduce the capital expenditures, and then come up with the free cash flow. If I see the free cash flow yield, basically if you invest, then how much the free cash flow, it's on the average, it's coming around, the free cash flow growth rate is 16%, but for the last 15 years, sorry, 5 years is only 13%, right? So it's not bad. Actually, it's very good. So, but and the average free cash flow yield as per my investment is less than 4%, right? So that's what's coming. So again, I have projected the free cash flow for the next 10 years, discount by the growth rate, and then my price is with the free cash flow. Free cash flow always give the conservative cash flow, so the value. So that's why I always like to include that in my model. And it's also give us the consistency, right? That the company is able to generate the cash flow. So that's pretty good. From the after the next 10 years, the price it's coming to 24.69, right, of the Google stocks based on this model, and the return is coming 16.61%. So now I have the price and the return. Let's get all these things together and see what is my the intrinsic value and the price, right? Okay, so as you can see now, I have these three models, and with these three models I got my this price, right? Three different prices. So the first price, so the first model price is this intrinsic value of 1600. This is the second model, and then this is the third model. Based on all these three models, right, I assigned almost equal weight to these models, just 1% extra to the free cash flow model to come up with 100% weight. And then I compute the weighted price, which is nothing but intrinsic value times the weights and sum it together. So this is the entry price, 1490.73 with this model. And believe me, I think it's just a coincidence that in the market right now, if you remember, the price is 1487 dot 1487, right? So $3. So it's pretty much, I believe, the security is fairly valued right now. If I take very conservative approach, right, and using this model and do this. So if I see from the return perspective, internal return perspective, right, again the first model give me almost 21.29%. This second and third model divided equally, so the return perspective means I'm getting close to 18% return, which is very good, I believe. And here I haven't taken the factor of my moats, right? The two moats which I have, the autonomous car and the health, or at least the autonomous cars. So if you factor that in, I believe that's the game changer with this of this stock. So for that, yeah. So what do you think about this stock? Do you think it's a buy, not buy? You still think 18% return is not good, right? Or do you think you prefer some other FANG stock rather than this stocks, right? From the innovation perspective, I think Google is the best. Search engine perspective is the best, and they don't try to afraid from innovations, which we can see. And search is back. It's very smart engine behind the scene, and we can see they are diversifying in other areas as well, which is very good sign. Not just relying on the search, which is still strong, right base. So for that perspective, I think it's pretty good stock. What do you think from the long term perspective? What do you think from it? If you want me to cover any of the stock, please do comment it. And I really, if you're new, please subscribe and like the video. Really, it motivates me to make these kind of videos. Right. Thank you for watching, and see you soon in another video. Bye for now.